Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
Well, let's kick off with inflation. So there has been a lot of focus in the US on the typical consumer's Thanksgiving basket. And the question being whether that basket costs less today than it would have cost last year. And if we look at some of the Thanksgiving staples, and this is very much like Christmas staples for any UK listener, turkey, cranberry stuffing, all of that seems to be down slightly since last year. And we're kind of getting back to 2020, just post-COVID levels. However, it's other, of course, the general consumer basket is a lot more than Thanksgiving staples. And we have been discussing a kind of a lower resting heartbeat, as another commentator has called it, of inflation at around the 3% level. And then in the UK, of course, resting even higher than that, the latest reading being around 3.6%. So Lindsey, over to you in terms of your outlook around inflation and whether we should be getting comfort from this Thanksgiving basket, or should we be looking perhaps at more broader indicators? Do you think it's resting now at a higher rate?
I think there's a lot of evidence to suggest that inflation is resting at a higher rate in the 2020s than perhaps before the pandemic. I'm not so sure that the monetary policy environment has adjusted to that in the way that everybody might have expected. We've long talked, for example, in the UK about the 2% target rate that the Bank of England has consistently failed to reach over quite a long period of time. We've had this persistently high inflation. But looking at the Thanksgiving basket, it's possible to interpret this as a basket of largely discretionary items. However, as everything with markets, it's a matter of perspective. It's always bad news for the turkey.
Absolutely. Well, let's move on to other vibes that we're getting out of the economy. And I think before we move on, I suppose it's safe to say that the consumer, we are very focused on the pressure on the consumer from all angles, certainly the lower end consumer, because even though they may not drive markets, they are certainly an important part of the puzzle when we talk about this K-shaped economy. And looking now at the vibes, so this is actually more of a kind of a strategist look at the vibes. In the past weeks, we've looked at some of the consumer sentiment numbers, which were softer, as we did expect, and sort of seemed to be in line with what we saw from the other sentiment we were getting out of the consumer. But when it comes to Wall Street strategists, it seems that Wall Street is 100% behind continuing bull run of the equities into 2026. So if we see, we don't ourselves at Moneta put a particular number on the S&P, but we can see that Wall Street strategists are bracing for this continued bull run past 6,500 up towards 7,000. And then when we look at the Bank of America Global Fund Manager Survey, they are equally fairly, I'd say 43% looking at a level between 7,000 and 7,500. It's impossible to pick apart where all of this is essentially coming from. Is it coming from the same concentrated names? Is it coming from elsewhere, but other more diversified names? But this seems very bullish. Does this surprise you to see this kind of positive sentiment?
It's not entirely surprising. It looks like we've been on a rather long bull run over the last year or so. That looks set to continue, but I think it's also important to remember that this sentiment can also be very fickle at times. In Morningstar's latest 2026 outlook, some of my colleagues observed that the forecast for the S&P for the year started off rather high. They were all cut very significantly after what is called Liberation Day, after the tariff reactions, and have risen again toward the end of the year. But still, a lot of those forecasts are sitting below where the market currently is. So we've seen these expectations reset several times over the year with all the volatility that we've had, and I expect there will be further resets coming in the coming months. It's always interesting to watch, though.
Yeah, exactly. So I was a little surprised by this because it did seem that there was certainly in the last month. It sounds like November is finishing about flat, and we'll talk about equity markets in a second, but it did seem that more negative news, or at least concern, was coming to the fore. And just continuing on the economic discussion. So this is initial jobless claims here, 2022 to the 2025. And we can see that there is looking at the beyond the black number being the 2025, what typically happens at the end of the year is that they will tick up as we get to the end of the year. Maybe there have been job cuts made throughout the course of the year. It's always particularly brutal to lose one's job just before the holiday season, but that does happen before bonuses are paid. And if patterns were to continue, we would expect to see things at least ticking upwards. This low hiring, low firing kind of equilibrium seems to be continuing. We don't have all the job data. As we know, there has been a bit of a blackout for at least a month in the US. Any thoughts there on whether this is likely to spike into kind of the type of crisis that would cause the Fed to act? Or do you expect kind of more of the same?
I think this slow rumbling along as everyone seeks to deal with the current policy environment is likely to continue in the short term, but who really knows what's around the corner? I think what is interesting to observe is that amid this sort of low firing activity, it really is interesting to see the focus that's being put on further interest rate cuts, which it does feel a little unusual to me.